Corporate finance practice problem using Excel. Rights offering introduction problem. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. Going to populate that into the blue area on the right-hand side, looking at a rights offering type of situation. Typical kind of scenario may be corporation needs capital, needs to generate some money, wants to do so by issuing stock, and would like to give the benefit then to the current stockholders by giving them a discounted price, possibly in the form of the rights offering to the existing stockholders, giving them an option to purchase at the discounted price. So we have the idea here on the left-hand side. We got the current stock price before the rights offering goes out at the $40. We got the exercise or subscription price, which we're going to say is $30, and the rights required to purchase a share is $4. So we're going to say they're going to be offering the rights offering out there, the price before this all takes place, $40, and then they can purchase then at the discounted price of the $30. If they then use up 4 rights in order to do so, they're going to get 1 right basically per share. So the first thing we can think about, what's the theoretical value during the time rights offering is announced until 3 days before the subscription rights expire? That could be called the come rights period. So we're basically thinking, okay, what's going to be the value of the rights? We would like to be able to distinguish the value of the rights and the value of the actual stock, because kind of we have 2 pieces that we're basically thinking about at this point in time. And so we want to basically be able to think about what are the value of each of those items. Then we can also then think about what will be the theoretical X rights price, the TERP, after this whole thing is going to be said and done, because the original price is 40, and you would think then that it would go down a bit because they're basically saying that they're going to sell some amount of shares at an amount that we would assume be below the market price, and that's gonna basically lower what we would expect the right would be after this whole thing is going to be said and done. So we'll talk about that then shortly. So the first calculation will look like this. This is going to be the right value during the come rights period, and that's going to be equal to the stock price minus the rights subscription price per share divided by the number of rights required to buy 1 share plus 1. That plus 1 is a little kind of confusing component that could change at a later point when we're looking at the rights value during the exercise of the rights period. So let's go back up top, and we're going to say, all right, then the stock rights are selling for, the stock is selling for the current price of 40. We're going to say the subscription price then is going to be, we said the 30. So if they give us the four rights, then we're at the discounted price of the 30. Underlining that, that's going to be the numerator of our calculation. That'll be the numerator, which is going to be equal to the 40 minus the 30. I'm going to indent the numerator here. And then, so we have that. And then we're going to take a look at the rights needed for 1 share. So how many rights do we need to be getting that discounted amount? We need 4 rights for that discounted amount, and then we're going to add 1 to it. So we're just doing this formula down below, and that's going to give us, of course, 5. So this equals the sum of 4 plus 1, 5. So that's going to be the denominator, and that'll give us the value of the rights. The value of the rights at this point in time is going to be equal to the 10 divided by the 5 or the 2. Let's do some underlines under the 1 font group underline and an underline under the 5 font group underline. Now let's think about this in terms of the theoretical X right price, meaning the current market price is $40. What's going to happen basically after this whole thing is said and done? So one way we can kind of get to that price, this is an estimate into the future, would say, all right, well, let's first look at the market price that is on the books now. The market has determined that it's $40 per share. Now let's think about the number of shares outstanding. And I'm just going to assume that there's 1,000 shares outstanding. So 1,000 shares outstanding, that's going to give us our starting value based on the market. So the market, if we were to think about the market, and I indented this by going to the alignment and indent, then we would think that the market then would think that there's 40 times 1,000. That would be kind of like the value of the company based on the market. It would, from an accounting standpoint, assets minus liabilities would equal equity. This would be, you know, the market prediction of kind of like the value of the company, the net value, but on the market basis. So we're going to say that's going to be 40,000. Now there's going to be new capital that's going into the company because they're going to be generating new capital by issuing the shares. That's why they are issuing them. So you would think then that the value of the company would go up by the money that they're going to be getting. So how much money are they going to get? Well, they're going to get the new shares that are going to be issued. The price we said was $30 for these discounted. We're going to assume that all these discounts are going to be cashed in. So if they are, then how many shares would be issued? Well, we have then it takes four of these to buy one share. Therefore, if we have 1,000 shares out there and all those shareholders got one of these options, and it takes 4 of them to buy a new share. So the 1,000 divided by 4 is going to give us the 250. So we expect new shares to be out there at the 250 new shares to be purchased at the $30 in essence, which is going to give us then new cash into the company of $7,500. So $7,500 would be the new cash or the new capital. I'm going to go ahead and indent that, alignment and indent. So after the new cash goes out, you would think the new value would be the 40,000 previous value plus the 7,500 would be the 47.5. So now we got the 47.5 at the new value. The number of shares that are currently out there now, we have now the number of shares was 1,000, we're assuming. Now we put in another 250. So now we got 1,250, font group and underline. So that means the theoretical X rights price, and I indented this in the alignment indent here, theoretical X rights price is going to be 47.5 divided by the number of shares, $38. That's going to be even, I believe, even 38. So that's going to be less than, of course, the 40, because what happened is we issued new shares, but we didn't get the market rate for them. We got something less than the market rate. We issued them at the discount. That was the point, to give the current shareholders the ability to purchase at that price. And of course, that means that we issued them below the value, the market value. So that resulted in what we expect the price per share to be after this time period, 38. So it was at 40, then it's going to be basically at the 38. After that. So now let's think about the during the exercise of the rights period, the period of time about 3 days before the expiration. During this period, rights may be traded independently of the stock. So you might have a situation where you can actually trade the rights independent from the stock. So if someone else wants to use the rights to purchase, you might be able to then break them up and basically trade the rights themselves. And so you have two separate kind of items with value at that point. So the stock price during the X rights period, we're going to say is 38, which in our case is what we calculated here in the theoretical X right price. So we got the 38. The exercise of the subscription price is the 30, and the rights required to purchase a share is once again 4. So now we're going to use our second calculation. This is going to be the rights value during the exercise of the rights period. So now it's a slightly different calculation. With the denominator, we basically took off the 1. So it's the stock price, but now the stock price is different. We're going to assume it's that 38 because now we're at the future time period minus the right subscription price over the percent of rights needed to buy one share. And then we don't have that plus 1 component. So we're going to say, all right, the new stock price. So the stock price here is going to be, we're going to say 38. And that 38 matches the calculation we had for the theoretical X rights price, 38 up top. We're going to compare that to the exercise price or subscription price, and that's going to be then the 30. Underlining that, font group and underline, that's going to give us the numerator, we're going to call it. The numerator, which is going to be the 38 minus the 30. And then on the denominator, we're not adding 1, so all we're going to do is take then the rights that are needed, just like we had up top, but not adding this 1 to it. So now we're going to pick the rights that are going to be needed for 1 share, and that's going to be then, I'll put this in the outer column, 4, it's still at the 4. underline in that font group and underline. That's going to give us our total. I'm just going to call the total down below, which is going to be 8 divided by 2. So that's going to be our 2 once again. So there we have that. If I scroll on down, then the next concept we can think about is the nil paid price. So if an investor chooses to sell his or her right outright on the market, or if they choose to let the right lapse, which may result in a minimal administration fee. In other words, now that you have the option of selling the right, you could say, well, I'm going to sell the right, or depending on how the right's going to be set up, if you let it lapse, you might pick up then the nil paid price, which could result in some administrative fee if that was the case. So they will receive the theoretical nil paid price of the right. This value is calculated by determining the difference between the subscription price the right investor paid and the theoretical X right price. So that calculation then being the current stock price or the original stock price of the 40. And then we're going to be picking up the theoretical X rights price. I'm just going to pick up from here, which is going to be that. I'm going to say this is going to be the 38 and underline it. We're going to say font group and underline, and then we'll subtract that out. That's going to be the 40 minus the 38, which we'll call the nil paid price.